As I started, understanding your balance sheet structure is extremely important. Know your products, know your product liquidity characteristics, and the client behavior. Keep assessing the client behavior for different scenarios. Once you have developed your sort of liquidity gaps, then shock it for different scenarios, stress it, and then determine your buffer accordingly to say where do you want to set it.
This is Liquidity Talks, a live stream and podcast series designed to share the latest trends and updates from the world of treasury, liquidity, and risk. Join us as we power up the liquidity conversation.
Hello and welcome to our latest instalment of Liquidity Talks live stream and podcast. My name's Neville Roberts and the CEO founder of Planix, the market leading fintech focused on real-time liquidity, treasury and risk. Now, our topic today is entitled How to Optimize Your Balance Sheet with Data. I think you'd all agree a very topical subject for today. Welcome to our audience today. Good morning, afternoon and evening, wherever you may be. I hope you appreciate today. I'm wearing my Christmas jumper in all its festive mood. So I hope you're all doing the same because it's December. Right, anyone in the audience can ask questions today. If you'd like to ask a question or make a comment, you'll see on the right-hand side of your screen the comment section. Just type a question or comment on there and we will endeavour to raise it during the next 30 minutes. And if we don't, we'll answer it after the podcast. Now, today I'm joined by our guest speaker, Sridhar Aiyangar, or Shri, from ABC Bank. This is a real bank talking about real life. So it's going to be really interesting. So, Shri, would you like to introduce yourself? Tell us who you are and what you do.
Yeah, hi. I'm Sridhar Aiyangar. Thanks for inviting to this talk. I head up the group balance sheet management function and liquidity management. I've been with Bank ABC for the past 7 years. Prior to that, I was with Standard Chartered Bank in London for many years, looking after treasury, risk, and financial market structuring and finance functions at different points in time. And so it allows me to obviously, get the benefit of all three dimensions, which are usually concerning any bank, which is treasury, risk, and finance in terms of profitability. So that's my background.
Good, perfect. Exactly what we need for this podcast, Shri. Now, I think you know that we do like to talk about football at the start of these podcasts just for a few minutes. And I know it pains me to bring this up with you because I know what the answer is going to be. But would you like to talk about who your team is and why?
Well, well,
Thank you
we've
for
been
that.
having
Let's
a
move
tough
on.
time for the
No,
past
go on.
several years now. So ever since Fergie left, we've been having tough times. So Manchester United is the team we support, and obviously we see that you're a Liverpool fan and doing great with where you are in the table right now, at the top of the table.
Well, tables, by the way, but I think we all know things go in cycles. So one day we'll reverse the situation, I'm sure. So I'm not going to say too much, but we could fill the podcast with the history of our two clubs. But let's get on to more exciting topics. So everyone, the topic today: how to optimize your balance sheet with data. So let's get straight into it. Shri, look, how can banks determine if their liquidity is optimal and ultimately have stable funding, which is obviously what every bank wants?
Yeah. So the starting point to all this is obviously understanding the business model, the balance sheet structure, the product characteristics, the tenor characteristics, and the behavioral characteristics of both your assets and liabilities. So that's your starting point. Each business model has different life cycle for cash, and banks in particular tend to do what is called as maturity transformation. So typically you borrow short and you lend long, and that creates a natural liquidity mismatch in the balance sheet. Obviously, then that requires a level of planning and working through the understanding of the data analysis and looking at various aspects of your balance sheet to forecast what is going to be your liquidity need looking forward under normal circumstances, as well as if there was a economic stress or a market stress. So that's the starting point. So once you understand your balance sheet structure, you do your analysis based on behavioral analysis as well as contractual. Do some stress tests based on scenarios that you develop, which are more realistic and plausible. Then ascertain your liquidity gaps,
Yep.
and then decide your liquidity buffers that you would want to hold, and then set your risk appetite and the economic, what do you call as early warning indicators, so that you can take preemptive actions. So that's the starting point.
Got
and
it.
then and then you work from there in terms of optimization. The optimization only can happen when there is greater predictability about your cash flows. So understanding your cash flows is extremely important, and which is where data at a granular level is very important. So you've got to understand not only your products but also your client segments, geographies, the concentration risks, and the stability of your profile, funding profile. All this come
Got
into
it.
play while you determine the optimal level of liquidity as well as stability in your funding that you need to have.
Got it. So look, there's some essential steps there in terms of improving liquidity management. What would you recommend in terms of the actions you should take around those steps?
So typically, you start with analyzing the balance sheet. So you look at the liquidity gap analysis, and then both in terms of contractual tenors as well as
Yep.
behavioral tenors. The behavioralization also has to be constantly validated, as we have seen. If you stick to a standard set of behavioral assumptions, you could potentially have situations where the market conditions are changing and customer behavior would change to that, and you haven't captured that. A classic example is of that Silicon Valley Bank,
Yep.
where they had assumed the current and savings account to be quite stable. And as interest rates went up, there was migration from non interest paying accounts to interest paying accounts, which resulted in their net interest margins to be compressed. The second thing, obviously, is when you assume your funding to be interest free as well as stable, there is potential for deploying that into longer tenor assets. And that's what happened in that case, where they were chasing yields with a very untested funding source in times where interest rates were rapidly rising.
Got it.
So the external factors has a lot of influence in the way you manage your balance sheet. And
Yeah.
that's why the scenario modeling and stress testing is very critical. And what is good today may not be good tomorrow. So you've got to
Yeah.
constantly assess that.
Got it. Just looking here, Sri, there's a question in already from Dan Feeney. Hi, Sri, as a correspondent bank, are legacy calls fit for purpose anymore? I could answer that, but I'll let you. I'll let you answer that one.
So, see, correspondent banks typically offer services for clearing to other banks. So, effectively, they serve a purpose of keeping the system with adequate liquidity across various entities. So, when you have forex transactions or remittances happening, and you may not have clearing in every currency available to you. So the correspondent
Yep.
banks serve that purpose. And also, when it comes to trade, you need correspondent banks because you can't have your branches everywhere in the world. So
Yep.
they do serve a purpose, uh, and I would say they're fit for purpose certainly because they do fulfill their economic needs for the economy. So it's very important to have that relationship.
Got it. Understand. Thanks for that. So we talk a lot on these calls about the regulator and the regulatory impacts. Um, how much do you think regulatory changes impact this strategy approaches that we've just been talking about, Sri?
So I would say regulatory aspect is important, but more important is the risk management for a bank. So the internal risk management takes over as the primary goal. Regulation is obviously what you would call as a operating requirement. So
Yeah.
regulations are often lagging. So typically you would find regulations are lagging. So market is actually going ahead and regulations are on a catch-up mode all the time. We have seen it several times. When Basel II was there, there was no liquidity regulations in Basel II. Then the
Yeah.
2008 financial crisis happened, and then they realized they missed out a big piece of risk, which is the liquidity risk, and the leverage. And came all the other things like LCR, NSFR, all the related metrics. So regulations is always playing a catch up. But Recently, we've seen obviously there is greater focus on intraday liquidity as well, as you are in the period of instant payment settlements, and also the fact that these days you're not exposed to bank runs, as they call now, they call it bank sprints. So in the case of
Yeah,
SVB, 20% of their deposits was lost within 4 hours. And if you contrast that to Northern Rock, it took almost 4 days for them to lose 30%.
yeah,
So people had to queue up in the branches, but not anymore. Now, transmission happens at the speed of light. So people are able to use their electronic devices and move funds. So the requirement for risk management is much more from an internal governance and risk management point of view rather than just regulation. So, as a business, as a going concern, your approach to risk management should be determined by your business model and the needs for that rather than purely
yeah.
meeting regulations. Regulations are also equally important.
I agree. And I remember with Northern Rock at the time, the anxiety and the pressure came. It was, it was the TV, it was the news, it was the papers. But with SVB, it was almost instantaneously. It was social media pressure, and you're right, it got around the world
Absolutely.
in like a few hours, and that just speeded the entire process up. And I think you've got to be aware of that. It's not just the facts; it's what people think and
Think of it,
how.
yeah. So yeah, that's the piece. With social media, I mean, it's not about the whether the information is true. It's just basically information is flowing and people consume it and then they react to it. And more so when it comes from some finfluencers, as they call themselves, there is greater impact from that. So particularly in the case of Silicon Valley Bank, where it was a very closely knit Silicon Valley, kind of startup venture capitalist funding client base. And once
Yeah,
a few of them get together and talk about it, and then it spreads quite quickly. And there were tweets which
yeah.
were said, which led to the acceleration of withdrawal of funds.
Yeah, no, I agree. I agree. And look, we often see the banks can have a great business case in terms of reducing buffer costs, improving their risk profile with liquidity, operational improvements. But sometimes the need for change or the push for change often comes from a regulator. So that's the catalyst to change, but the
Sure.
value comes from elsewhere. We see that very often, and I think it's happening more and more.
Yeah, banks tend to react more to regulations
Yeah,
than, looking at things in a risk sense to say, are we in the right space from a risk perspective? It's often driven by the need to drive returns, and
yeah,
that's where you had the past examples of as short-term reliance on funding, short-term
yeah,
funding, which was the reason why you had the likes of Bear Stearns or Lehman Brothers collapse as asset
yeah,
values collapsed and the short-term funding market shut down. There was no way they could meet the margin calls, and that
yeah,
led to the sort of downfall. But more
got it.
importantly, I would say for a bank, it's very important to not only assess your risks, but also develop a very good contingency funding plan, which is
Yeah,
tested, regularly tested. Now, good thing is, as a result of these bank failures, central banks have also been more open in terms of, refinancing arrangements. So they've expanded the range of collaterals they will accept. There is also pre-positioning available where you can pre-position the assets and draw liquidity on a same-day basis. So those are some of the factors which have been as a response to previous crises. So
got
that's
it.
helped to bring some stability to the financial stability to the system, and also allow banks to, reach without any stigma, access these central bank source of funds. And
Got
recently,
it.
we've seen Fed encouraging banks to use their, liquidity facility. So the stigma attached to accessing Fed funds is removed.
Yeah, no, got it, got it. All right, let's change gears here, Sri. If you think about, how can banks leverage fintech innovation of what obviously we want to enhance and enhance liquidity management and stable funding? How can they best view fintech innovation and embrace it?
So yeah, so fintech comes in several ways. So one is obviously the customer user experience. So obviously, when you have a fintech front end, it allows customers to access their information in real time and able to facilitate transactions at a lower cost. For the banks,
Yeah,
obviously, as you adopt straight-through processing, it improves the operational efficiency. But also, fintech helps banks to analyze data in real-time basis, so which is very critical. So, as we look at, for example, managing intraday liquidity risks, you ought to have a real-time view of your cash inflows and outflows. So fintech would help in not only analyzing data on real-time basis, would also help in giving good forecast in terms of under different scenario analysis. So we could potentially look at next week or next month or so or a next year basis to plan your funding requirements or liquidity requirements accordingly. So
yeah.
there's a lot of cost that can be saved when you are able to forecast your requirements well in advance and also take preemptive actions rather than wait till a crisis hits you.
Absolutely. And Sri, we at Planet talk a lot about the fact that banks need to move from end of day to intraday to real time. So, in your view, why is real time information important for this whole topic area?
So, see, the emergence of instant payments is forcing banks to get into real time space. And
Yeah,
also, you have the recent liquidity guidelines emerging from both ECB, EBA, and the PRA is directing banks to move towards real time intraday cash management. So, as financial system is integrated, failure of one institution can have knock-on effect on many. Hence, it's very important for market participants to be alive to the implications of instant payments.
yeah. No, got it. I'm going to ask Nick if you could post the link to the ECB uh, liquidity publication in the comments section. Everyone can have a look because that came out 2 weeks ago, and that was very strong from the ECB in terms of this is what we're going to expect when we come and talk to you as a bank. This is what good practice is. This is what
Yeah,
best practice is. This is what good practice is. But we're going to expect you to be up there and doing those things that we say. And we've been waiting a year or two for that, probably ever since Credit Suisse and SVB. But it's now pretty clear what banks have to try and achieve, and whether or not they're close or they can get there remains to be seen. But we're here for them.
yeah. As you mentioned, Credit Suisse, that's a very interesting case study for me. Credit Suisse fell not because of lack of liquidity, but because lack of trust. So effectively,
Yeah,
they tripped from one crisis to the other without addressing the risk culture holistically. So effectively, they started off with spying scandal, then was the COVID breach, then the
yeah,
Archegos, and then the Green Sill, and then the principal shareholder withdrawing. So they sort of muddled through each crisis without
yeah.
fundamentally
Accumulation.
addressing the risk culture. So while it was a
Got
very
it.
strong institution on paper, uh, but when trust goes, everything goes.
Yeah, no, absolutely. So, look, talking about risk culture, what does this mean? Does this mean banks can foster a stronger risk culture, driven by the more analytics they have, and also I'll combine that with Dan's other question here about how can the risk and compliance departments collaborate better? So, can they collaborate, and does it foster a stronger risk culture?
I think risk culture obviously is the at the heart of everything. So that comes from the board. So driving a very strong risk culture is quintessential to have a very safe banking operation. So that's a given, I would say. Collaboration between compliance and risk is very essential as well. So effectively, what happens is as compliance is at the forefront of regulations, emerging regulations, there has to be greater collaboration between risk and compliance as well as other parts of the bank to understand the implications of the regulations and then prepare for those challenges. So certainly, we see a very strong integration between compliance, risk, and finance.
Got it. Perfect. All right. And there you just see Nick's just put in the link there to the ECB report that came out. I did recently done a post actually in LinkedIn that said it's our user guide. But it's a very close link actually. It's very good for us. But that's
Yeah,
definitely worth a read because the ECB is going to turn up with this paper at your desk and ask you to answer this, right?
That's true. And also, what they've done is actually explain what does a best practice look like. So it's a good
Yeah,
document to read through.
perfect. Right. Talking about best practice, do you think these can be applied to different sectors beyond banks so they can be more broadly
See,
applied?
certainly, because I see the non-bank actors are also creating liquidity risks for the banking segment. So I've seen recent consultation paper on crypto assets, for example.
Yeah,
So there are regulations emerging for crypto assets. There are also regulations emerging for non-bank financial companies, so which are
yeah.
also reliant on banks. So, hedge funds are the other ones which also pose systemic threats to financial institutions. So certainly the regulations will expand and extend to other participants, market participants.
Yeah, look, and I think it's not just what liquidity do I have and how much do I have to hold. It's understanding the reasons why as well. So, we provide a view on looking at the corporates who are impacting your liquidity more or the most, and banks get a surprise when they say, "I didn't realize that corporate makes use of the liquidity that much." But some of them are pretty skilled in that in terms of the intraday liquidity usage may look fine at the end of the day and the start of the day, but during the day, pretty heavy usage. And you can now get to that analytics and know who's using it and exploiting it.
Yeah, that's the other interesting thing. So effectively, as we move to real-time liquidity management, there are, parts of the day where you could be deficit, there are parts of the day where you could be surplus,
Yeah,
and there could be an emerging trend. I think it's probably in the future, not too distant in the future, where you could fund liquidity requirements for fractional portion of the days. So instead of overnight funding, it could be 1 hour funding or 2 hours funding, and people could actually monetize surplus liquidity to other participants where there are deficits.
I
So
think that's coming in actually. I
yeah,
do. I've heard about that. I've seen some examples of that, and because ultimately the world may move towards intraday charging as well. And if you're moving to
yeah,
intraday charging,
exactly,
that's
exactly.
another route.
Yeah.
Good. All right. So looking into the future, whether it's now or in the medium to longer term, what emerging risks do you think banks should be aware of in this whole space?
So immediately you see the sort of the TLTRO is coming off. So there is going to be some liquidity pressure emerging for the European banks.
Yeah.
You also have this Trump effect of what tariffs may come into play, and what does it do to inflation and thereafter interest rates. And
Yeah.
liquidity is very much linked to these, whether it impacts trade or interest rates. You have consequential impact for liquidity, and then of course the geopolitical risks that remain. So in the near future, I think these are the three major areas where you could potentially get some liquidity related impacts.
Yeah. And those are things that are not easily forecast or planned or easily understood, I guess, or where it can move. Who knows how these
Yeah.
geopolitical events can move and what's going to happen?
And the fiscal policies, you saw what happened
Yeah.
in September 22, when Liz Truss and Kwasi Kwarteng literally,
Mm,
demolished the the
yeah.
conservative management of fiscal policies. Within a matter of a day, you had gilts jumping from 160 basis points to 400 basis points, uh,
Yeah.
cable dropping from 122 levels to 110 or below that. So, these are shocks that come from nowhere. You can't predict these happening, and which is what makes the whole area of liquidity risk management much more challenging and
I
interesting.
was going to say maybe not exciting, but certainly challenging. And I think, look, we used to talk about, we still do talk about black swan events, but it seems like a black swan event these days. It's not every 10 years, it's like every year or every 6 months, and
Yeah,
you never know when it's going to happen. But it's happening more often than it used to, I think.
that's true. That's true. And
Good,
also,
good.
it's amplified because of social media as well. Everything is
Uh,
amplified so much.
I know. Well, I mean, I feel if I haven't read the news in the morning, I'm not equipped for the day because something will have probably happened, and I need to at least know because
Mm.
one day it'll catch me out, and you have to know to react. So you're absolutely right. look, what would be really interesting, because you work at a bank, and with your role, can you share an example? You don't have to go into as much detail as you want, of a liquidity crisis that you've seen or you've experienced and how it was managed. Love to hear that if you've got one.
Sure. So uh, I can talk about the 2008 crisis when I was at Standard Chartered. So effectively, the market seized up, and there was clearly a period of lull before even the central banks could react. And we were in a situation where we had strong liquidity positions, and thankfully we were not impacted by the events because we didn't have any CDO in our portfolio. There was one
Yeah,
there was one liquidity fund which we are managing, which had some exposure, but then that's about it. Uh, so we were in a strong position where we could then offer solutions to other institutions, which is what we did through structured liquidity transactions, whereby helping other units to liquefy their or monetize their illiquid assets. So we created,
yeah,
structured liquid funding program. And also
mm,
we consulted as an institution with the Bank of England and the FSA at the time how to bring liquidity back into the system, how to put some, and most of them were focusing only on liquidity, while capital was also an issue. So effectively, then came the guarantee program and asset values. So effectively, we tried to work with the government to try and bring some stability into the financial system. That was a very good experience. More recently, I would say it was not a crisis. I would say a mild stress, which came during the COVID time when there
yeah.
was lockdown in March 2020. So, because of our strong stress testing analysis and the preemptive actions that we took, we went ahead and raised term funding towards that time in early March 2020 to see through the crisis because we didn't know how long the lockdown is going to last. And it lasted longer than what we had anticipated. So it was a wise move to have shored up a funding profile. Uh, but clearly, the analysis helps because COVID kind of stress doesn't impact all industries the same way. So you have the
Yeah.
transportation, airlines, or the hospitality, or transportation sector impacted more compared to, let's say, there's a favorable effect for IT sector or pharma sector where they are actually benefiting from that crisis. So understanding your balance sheet profile to see what are your exposures to different segments, as well as where are your funding sources from which client segment helps. And that's what we did during that crisis to understand the liquidity requirements and went ahead and took a preemptive action to raise funding.
Got it. And in 2008, were you ready with those offerings then, or you created them at the time? So I'm not asking you whether you foresaw the crisis, but was it a matter of powering up the offerings you have or creating new ones?
So effective, you see, so what happens is the we started when the actually lockdown was announced. So,
Yeah,
but everyone thought it would be 2 weeks or a month
yeah,
max, right? So
I
we
remember.
took the yeah, so we took the view that this could go on longer, and that's where we took a more conservative approach.
Yeah,
And then we analyzed our balance sheet and funding structures and the asset structure. And there was forbearance as well from the central banks. They were allowing payment holidays. So your cash flows inflows are not coming in the same way as you had anticipated previously. The contractual inflows wouldn't happen because there was forbearance measures from the central bank. And then the fact that you had to bring that into your analysis to say that there is going to be deference. And then you assess your cash requirements and take actions. And yes, we had to raise cash. We probably raised paying a little bit of a premium at that time, but that proved to be the most sensible thing to do.
got it. All right, we're running out of time here, Sri. But finally, if you were to give us just a few takeaways for the viewers today, what would they be?
Well, as I started, understanding your balance sheet structure is extremely important. Know your products, know your product liquidity characteristics, and the client behavior. Keep assessing the client behavior for different scenarios. Once you have developed your sort of liquidity gaps, then shock it for different scenarios, stress it,
Yep,
and then determine your buffer accordingly to say where do you want to set it. Once you set your buffers, also set the metrics you want to monitor, the key metrics that you would monitor, and set early warning indicators for each one of those. And once you set them also develop your contingency funding plan, whereby you have identified what would you do if a crisis were to hit, and then test those from time to time. And those are the sort of what I would call as mantras to keep your balance sheet liquid and funding stable. And look at your concentration all the time. So funding concentration is not addressed in any of the metrics, liquidity metrics, whether it's LCR, NSFR, intraday, whatever you do. There is no measure for funding concentration, and
Yeah,
that's
it's
very
true.
critical.
Yeah.
So as a internal risk management function, you got to make sure you're not too concentrated, and if you are, then recognize the concentration and ensure your buffer adequately is raised to deal with that concentration impact.
Got it. Perfect. And that all means you need insights and you need them in real time.
Absolutely.
And then,
Yeah, data is the new oil, as they say. So it's
no,
always
I hear.
knowing your data at a granular level is the most critical aspect.
Perfect. Look, well, I think we could talk all day about this, but unfortunately, we've run out of time. So, thanks very much, Sri, for joining us today and sharing your views. If anyone asks any further questions or we have any coming through, we'll answer them after the event, of course. So that concludes our latest Liquidity Talks live stream and podcast today. We'll put the podcast on LinkedIn, Spotify, Apple Music, and other media outlets and streaming services very soon. Thank you very much for everyone for joining today. Look out for our next podcast coming next month in January. My name's Neville Roberts. Thank you for tuning in, and goodbye.
Thank you very much, Neville, for having me, and it was indeed a pleasure.
Cheers. Bye, everyone.
Thank you.
You've been listening to Liquidity Talks. Don't forget to subscribe to stay updated on the latest developments and industry opinion from the world of treasury, liquidity and risk.